Okay, welcome to our January 7th trade alert. Today we're placing a trade on the EEM ETF. That's the Emerging Markets ETF. Primarily investments in China, but it does give you some exposure to many of its trading partners, including countries in the Middle East, India, and surrounding Asian companies. This does exclude, however, Japan. Now, if you're following us daily, we're covering different countries each day. So yesterday we covered the US balance sheets, which has grown $10 billion week over week and is a primary driver of equity prices right now. We also took a look at Canada, Mexico, and Brazil, all pointing up for stocks into 2020. Now, today's trade alert is using 10% of our total portfolio. So we're willing to take a little more risk with a smaller portion of our assets. In today's trade, we're selling to close the January 10th 4423 emerging market ETF put option that we've been holding for several weeks and replacing it with a strike that's slightly higher and expiring January 17th. So that's the 4450 emerging market EEM ETF put option. No call option will be sold on emerging markets until we reach the $50 plus price target, as I'm expecting at least a 17% rally in early 2020, and also the potential for the emerging market ETF to outperform the SPY. Now, keep in mind the SPY is at all-time highs or near all-time highs, whereas emerging markets is still catching up. So its PE multiples are much lower versus the US. If we take a look a little lower in the trade alert, and let me zoom in for everyone, we can review our previous results. So this position was initially put on 12/17, and we are able to close it out today. We started the trade at 44.21 on emerging markets. And at that point in time, it wasn't so clear that the phase one trade deal was really going to be signed and that China would live up to its promises. So we paid for a very expensive 61-cent put option that would protect our position through January 10th. We've seen this position go up and down in value. It is a little less valuable today than it was just a few days ago before the Iran attacks began. However, we still closed out this position with a 15-cent gain on 3,800 shares, or a profit of $570. Now, the current trade is very similar, just a shorter duration. And if we pull up our risk graph real time, you can see we're spending about 34 cents at the current price to provide downside protection on 10% of our portfolio. So if we're so bullish on emerging markets, why would we want to pay almost 1% for downside protection? Well, we have seen some news popping up today that China may not sign the trade deal, although we've seen other reports that they will. So far, it does look like they will, and we've seen them pulling back tariffs. We're also seeing headlines that they're not going to increase quotas to reach this $50 billion a year agricultural purchase that's been promised. In fact, I don't know about you, but I haven't seen the trade deal. In fact, no one has. We don't really know what's in it or who's going to sign it. So when we consider that, we have some very bullish arguments, primarily that the interest rate levels are very low. And now 4 out of 4 of the major central banks are in an easing period. They're buying up government debt, which is taking stress off the bond market and allowing hedge funds to go all in on stocks. So from that perspective, we like taking risk in equities. But from the perspective that we still have not signed this trade deal, it's a week out, I'm happy to pay 34 cents for downside protection. And essentially my bet is that between now and next Tuesday, emerging markets will increase in value at a greater pace than 34 cents. And if so, we generate a nice profit. Now, on the other side of the coin, if we're wrong and emerging markets does sell off, we're protected. The least we get for our shares is the 44.50, and we also have to eat the cost of our downside protection. So you can see in this risk graph, we have a limited downside risk and an unlimited upside potential. So if the emerging markets jumps up $1, $2, or $3, all we lose is the value of our put option. Now, I do suspect this will be the exact same trade replicated for the next several months until we do get to higher levels. At that point, I'll be happy to sell call options and buy more expensive puts to protect the gains that we've accumulated. Also, as the trade deal becomes more clear, I'll be happy to also spend a little less on our downside protection. And again, our goal in this program is not to outperform the underlying asset. It's to create safe returns with low volatility. I do see some chats popping up. Let's take a look. Okay, it looks like we got mostly just some comments. Mark, is your screen looking clearer yet? And we have a few questions, so let's go ahead and stop, take some questions from the crowd before we continue. Mike has his, okay, I've unmuted you, Mike. If you want to speak, you should be able to unmute your microphone. Also, you can use your chat box.
Yeah, and folks, to locate the microphone icon, just scroll to the very bottom of your screen. A gray bar will pop up, and in the bottom left-hand corner, click the microphone icon, and it will unmute your microphone so you can interact with us live here.
Okay, I'm going to go ahead and continue until I do see some questions, but feel free to unmute your microphone, Mike, and post or use the chat box. Next, I'm going to review our open positions, and then we'll jump into the news and analysis that is looking at the risks and rewards ahead for emerging markets. Our SPY trade is doing well. We put this on yesterday. This was a loose option caller. Now remember, the SPY is trading at very high multiples and near all-time highs. So it is arguably more overvalued than emerging markets at this point in time. And that's why we want to be a little more precautious while trading the SPY. Also keep in mind, we have the luxury with the SPY to trade it 3 times a week because of options expiring every Monday, Wednesday, Friday. This is a unique aspect for the SPY that's not available on other ETFs. The position we put on the SPY started off at 322.30 and has jumped up by $1.15 to 323.45 as of updating the track record this morning. To review our position, we're short, meaning we sold the 325 call option. And all that means is we're agreeing to sell our shares for $325 a share, which is a lot more than they were worth as of putting on the trade. And then we're long the 320 put, which means we've purchased the downside insurance of a 320 put. In other words, we'll get no less than 320 a share on the SPY, no matter what happens. So Iran and North Korea can go fire off nuclear weapons all they want, attack oil tankers, whatever. If the stock market sells off, you get 320 a share because you had the smarts to put on that downside protection. To open that trade, we spent 29 cents or $29 per contract. And if we were to buy that back currently to realize the profit, we would have to pay another additional 18 cents. Right now, our net profit on the SPY from yesterday is up 68 cents on 1,900 shares. Now, remember, we're pulling in profits or potential profits on the SPY 3 times a week, and we're using half the shares as we are the other ETFs. The SPY does represent 40% approximately of our total portfolio. And in our portfolio currently has a 68-cent profit per share or $1,292 open profit. GDX has been selling off a little bit ever since the Iran news has settled down, but it's been holding on to its gains. Now, when we put this position on back on 12/19/2019, gold had been selling off for 3 months. So although we had all the right elements, we had fear, we had low interest rates, and we had central banks increasing their balance sheets, we weren't getting the price action we wanted to see. So we paid a relatively expensive put option that was in the money for $1.15. And to realize a profit on this trade, we had to pay off that put before going into the green. So currently we're up 58 cents beyond the cost of our put option, or a profit of $2,204 on this position. Now, I also was going for longer duration puts over the holidays to make life easy for our investors and also to save a little cost on the puts. So come Thursday, expect to roll this put option and play it very similar to emerging markets going into 2020. Now, my outlook for gold is to have modest gains in 2020 and to see some explosive gains into 2021 and 2022. And that is if we see rate cuts towards the end of the year and not towards the beginning of the year, and then go into quantitative easing into maybe Q2 of 21. Now, there are some very notable experts, namely Zoltan, who used to work for the Fed, who's predicting that QE could begin even sooner and just skip rate cuts. Now, if that's the case, then gold could be rallying much sooner than 2021 for the explosive gains we're expecting. We'll be covering this position in great detail on Thursday, as well with our TLT position. Now, TLT, I'm guessing most of you were assigned. If you're not, it'll still work out to the same math at the end of the day come Thursday, but we were assigned. And so we had sold an in-the-money call. So at this point in time, our current entry point of last Thursday, I'm not saying when you first bought the TLT, but rather just tracking the profit loss week over week, which is what we do in our daily update. We entered the TLT at 137.13 with a downward bet by selling an in-the-money call and buying an in-the-money put. Current trading price is at 138. So if you were assigned, you were forced to sell your shares for 135 per share, which is upfront a $2.13 loss from when we entered the trade. However, we collected $2.50 selling that in the money call, which nets out to a 37-cent per share profit from the assignment of our in the money call option. Now, we're still long the January 10th 138 put, which originally cost $1.54. Currently, it's valued at 64 cents. So after you add in the 37-cent gain, we're at a net loss of 53 cents per share on 3,800 shares on the TLT, or a loss of $2,014. Now, we still have a few days before we close out this trade, but our expectation is that yields must rise into 2020 without a new major fear. And with balance sheet growth, we've seen a very repetitive trend in history. When rates are cut, bond prices go up and yields go down. And this is usually in the face of stocks crashing. When the central banks are increasing their balance sheet and holding rates flat, which is the current market regime we're in, yields rise, bond prices drop, and equities rally. And again, that's exactly where we're at this point in time. So if you were assigned in this position, do not repurchase your shares on the TLT until Thursday, trade alert, because remember, we are currently betting down on the TLT, which means we think yields will rise. If we look at our updated returns, we began this program mid-December of 2018, right during the Christmas massacre. And we've had a great run. So far, our biggest loss from start of a month to the end of the month is negative 1%. Intra-month, we don't have tracking on that, but the largest drawdown was a little bit less than 2%. So closing out from the start of a month to the end of the month, we've never had a loss greater than 1%. We've averaged just over 1% a month. And over a 90-day stretch, we've never lost capital. Here's a look at our trading plan. Now, this is per $75,000. Most of our members have anywhere from 5 to 10 sets of this in their portfolio. And many people like to start off small and load up as they gain confidence. But per $75,000, we have an approximate 50% equity position, 40% bond position, and 10% gold position. However, that doesn't mean we're just long each of those assets. We use the options to make the trade become directional and protected. So 40% approximately is trading the SPY Monday, Wednesday, Friday. 10% trading emerging markets on Tuesday. 200 shares of the TLT representing about 40% of your portfolio on Thursday, and then 10% of your portfolio in GDX. Now note the price of GDX is less than emerging markets. So our gold position is a little bit below 10%. And that does give you some extra capital to follow our Friday bonus trades that are issued in our bootcamp program. And if you don't follow the bootcamp program, just know you have a small cash position that you can put to use when we have extra trades that may be a debit to your account. Next part of a trade alert is always a look at the S&P 500 against our returns. If you're trying to beat the market, this is not the right program for you. If you're trying to have low volatility, protect your nest egg, and safely grow your portfolio, I think you'll be very impressed with our results. Finally, at the very bottom of your trade alert, you can see how to get out and in of the current trade alert. So the current trade, if you did take the previous position, is to sell to close your January 10th, 44.23 put, and then to roll into the next position, which is to buy to open the January 17th, 44.50 put. So we just push that strike up one notch and move the expiration 1 week out. Now, as I do see this trade deal actually signed and more signs that China is going to grow its debt, we can get a little more aggressive and spend less money on our downside protection. We're just not quite there yet. If we look at our risk graph, that's the final screenshot in your trade alert. And again, on the x-axis, looking left to right, you can see the price of emerging markets in the future. And if you look up and down the y-axis, that's your profit loss. Now, this is not exact, as it doesn't quite know how to calculate or predict the implied volatility in the future or the time premium value, but it does give you a very good idea of what your maximum loss could be at the expiration. And in this case, it's $68 per contract, or just over 1.25%. Now, again, this is on 10% of our total assets, so you can divide that by 10. And we're risking very little week over week to carefully generate a profit from emerging markets. Okay, now I do have a video to play that shows the analysis of this trade alert. Oh, Oscar says you will outperform the market. Yeah, so that's a great point. Oscar did point out that we do outperform the market like clockwork when it's not traveling straight up. And so thank you for that, Oscar. We do have a good track record of being able to predict, or at least be prepared for downside moves, and to really look like a hero during those periods of time. Now, 2019, a monkey could have thrown a dart at a newspaper to pick stocks and done very well. Will 2021 be the same? And my forecast is that yes, for the first 3 to 6 months it will, and then we're going to get a vicious sell-off as yields get too attractive. So the easy money may have a few more months, and then you're going to have to get a little more nimble. Okay, I'm going to play my analysis video, and then we will go to Q&A. And again, this is a series of clips I put together in the morning. So you get a feel for the research I'm doing to support our thesis going into 2020, to look at the risks ahead and to determine where in heck we should put our put option to protect against risk. Okay, let's play this and then we'll jump into Q&A. All right, let's take a look at the analysis for our emerging markets trade alert today. First off, we're watching the threat from Iran, which seems to be toning itself down, although we don't know what exactly Iran will do to retaliate. My guess is it will be a surprise and in the future, and nothing that we can trade in the immediate weeks. But we have seen them assessing 13 scenarios, while America's threatening 52 Iranian sites. Oil's beginning to fall, which will take away some inflationary pressures, which are picking up in Europe's inflation reading today. Investors are piling into Chinese markets, according to Bloomberg, of course, who has a lot of money invested in China. And then we have this European inflation number picking up at the end of 2019, but mostly from increase in oil prices. Now remember, Europe does not include rent as part of their inflation print, so that keeps it artificially lower alongside their very low interest rates. In Bloomberg's Asian close, some headlines: 2,200 Marines, 3,500 soldiers sent to the Middle East. They're joking about the Iranians attacking Trump hotels. Chinese Foreign Ministry Wang Yi called the U.S. killing of a top Iranian general unacceptable, but he didn't use words like condemn or denounce. So hard to see World War III happening without China, Russia, and Iran all teaming up together. Now taking a look at terms of trade. Davos is in 2 weeks, and we're having a conflict with France currently regarding their digital tax. Now I'm looking at a newsletter issue from Yardini Research, Geopolitics Between Iran and a Hard Place. So what's next in the Middle East, where the chaos is normal, and more often than in most other places on Earth, Iran's mullahs may have no choice but to retaliate against the U.S. and its allies for killing their top general. He says the most extreme scenario could be that they start attacking oil tankers in the Strait of Hormuz, or perhaps re-attacking Saudi Arabia's Aramco facility. And I love this quote from his newsletter: the roaring 20s or the miserable 70s. So my expectation is we're maybe closer to 1965, leading into a period of runaway inflation and entering into the 70s, but perhaps we're at least a couple of years, maybe a half decade away from such an event. And again, if there's inflation, that's negative for bonds and stocks and would cause the Fed to raise interest rates, which would protect the dollar and probably what the U.S. really needs to do to remain a sovereign in the near future. John Bolton confirms willingness to testify if Senate is subpoenaed. So this is very interesting what he would have to say related to Ukraine. And meanwhile, Pelosi continues to hold the impeachment proceedings until they agree to allow John Bolton amongst 2 other witnesses. Meanwhile, the Fed term repo oversubscribed, so we can expect balance sheet expansion, bullish for stocks. We'll be looking at other central banks' balance sheets today. And more developments in Iran. While ordinary Iraqis were gathering with their families, Qaeda Hezbollah launched Katyusha rockets around Baghdad. I'm outraged that these Iran-backed terrorists continue to threaten the safety of Iraqis. When will the government start protecting Iraqis from these thugs? Starting to see some questionable comments about the trade deal with China. There are some areas where both sides need to work out more details. For example, both appear divided over the specific quantity of China's purchases of U.S. products. And we're seeing that they're not going to meet any sort of quota, as Trump had indicated, with $50 billion a year of purchases. But they have been ramping up purchases, so we'll have to keep a close eye on that. On the same note, we can see that the U.S. trade deficit has crashed to the smallest since Trump was elected. So his tariff trade wars are working in terms of decreasing the U.S. trade deficit. Overnight risk rally fizzles after Iran vows historic nightmare retaliation, evaluating 13 retaliation scenarios to inflict historic nightmare on U.S. China embassy issues U.S. travel warning amid threats of terrorism by Iran. China will not increase annual import quota for 3 major crops, wheat, corn, and rice, said Wang Yun, China's vice agricultural minister. It had been expected the authority will raise import quota or remove quota limit for the crops to increase farm good imports from the U.S. Meanwhile, the protests in Hong Kong continue with 800,000 this weekend. And in this video, we can actually see protesters attacking police officers. Some other Hong Kong headlines: dozen arrested after Hong Kong protests taking aim at Chinese traders. Same headline from The Hill. Hundreds arrested in Hong Kong in New Year's Day protest. More than 1 million people marched through Hong Kong as protest leaders pledged to keep the fighting for their demands in the new year. On the first day of the new year, more than 1 million people in Hong Kong showed up to continue the fight for democracy against tyranny. These pictures are just unbelievable. Repo panic returns as Fed injects $99 billion in liquidity, including the first oversubscribed term repo in 3 weeks. Then 2 interesting headlines on the trade deal. Stocks sink as Global Times suggests China is in no hurry to sign a deal, but then their counterparty, based on what I know, the Chinese side is actively preparing for signing phase 1 trade deal with the US. This is absolutely critical for our entire thesis on being long risk and short bonds. Headlines at Drudge: big tech gets bigger and bigger, form of government censorship, Trump touts Zuckerberg, Bolton ready, executive privilege fight, cracks in Republican unity, pressure on Pelosi. Wall Street Journal echoing the same headline: stampede at funeral, procession for Iranian commander leaves scores dead. USMCA is being held up by the Senate as they wait for Pelosi to push the impeachment articles. Headlines at zero: Iran evaluating 13 retaliation scenarios to inflict historic nightmare on U.S. Boeing soars on rumor Buffett is building a stake, and cryptos have surged since Soleimani's death. Bitcoin tops 8,000. Next in our analysis, we're keeping track of the debt growth or money supply growth in China, Germany, and South Korea. And so we can see the money supply has increased 8.2% year on year, which is in line with their 6% growth target, although they are having to increase the money supply slightly more than their growth target. We can see that the German central bank has been staying relatively flat over the past 2 years. So again, this is not supportive of a bullish stock market in the region. However, with China still expanding its money supply and beginning to create more infrastructure projects with a truce, at least in the trade war, I think this will be okay, and it continues to give us a good leading indicator in terms of Germany's interest rate policy, and especially the yield on their 30-year, just how well China is performing. And also in South Korea, we can see they have been hesitant to add capital to their balance sheet in South Korea. Okay, now we are looking at emerging markets compared against MCHI, that's the Chinese index, EWG, Germany, and EWY, South Korea. We can see Germany has been certainly lagging emerging markets. The Chinese index is outperforming by a 6% ratio gain versus emerging markets, and South Korea is slightly trailing behind. Now zooming in on a 30-minute chart, still using the comparison, we can note that China, the biggest piece of emerging markets, is outperforming. So this is a great leading indicator for us for the easier to trade, more liquid EM ETF, or emerging markets EEM ETF. Here's a look at BNDX, the largest emerging market corporate bond ETF. And you can see it's still trading at near all-time highs. This means that corporations in emerging markets do have access to capital to buy back their own stocks, namely from our point of view, but also to fuel operations. So that's healthy. The second ETF to track for corporate bonds in emerging markets is EMB, also at a very healthy level. Not as high as we've seen it in 2013, but still in an upward trend. And once again, this is bullish for emerging markets. The exchange rate between the dollar and the yuan is probably the single easiest indicator to predict emerging markets' direction. If this currency is strengthening, things are going well with the trade deal, and emerging markets tend to boom. And it has been strengthening. I suspect this will continue to fall and strengthen in favor of the Chinese yuan, as long as they are making agricultural purchases, which should lead to the US rolling back some tariffs into 2020. In the long run, I do think this currency is highly overvalued and will find itself weakening into 2021 as we find that the main problems between the US and China are not easily resolved, and that we're currently just in a period of a truce rather than a real resolution. And here, finally, to wrap up our analysis of emerging markets before placing our trade alert, are some headlines specifically for EEM from Seeking Alpha in the news section. Now, I'm not looking at analysis, just headlines. Ramco included in the MSCI Emerging Markets Index. MSCI boosts weight of China A shares. IMF sees 2019 global growth at the slowest pace since crisis. 3% forecast 2019, picking up to 3.4 in 2020. If this is true, emerging markets should outperform the SPY. All right, let's take a look at the analysis. Okay, excellent. All right, guys, I'm going to go ahead and open this up for Q&A now. Do we have any questions out there? Let me go ahead and unmute all.
Hey, Jason, this is Ron. I just have a quick question on TLT.
Sure.
You're predicting it to go to 120.
Correct.
Why don't we just wait until it gets to 120 and buy it again?
Well, you certainly could, but there's a lot of money to be made shorting it from current levels. So in our portfolio, we're basically playing stocks, bonds, and then inflationary fears with those three core assets: stocks, bonds, and gold.
But I guess what I'm saying is if you have the stock and the options, if the market's going down, you're going to still lose the money, right?
No, absolutely not with our inverted option collar. So I could pull that up. That's a great question, though. So yeah, this is really one of the most clever ways you can bet down on an asset and generate a profit safely. If you've ever tried to buy put options, I'm sure you've learned the hard way just how difficult that can become. So we're essentially trying to finance free put options with our strategy. So let me pull up the most recent trade. So this is the net result that would occur from the TLT, even after owning it. Now, if we get assigned, we can make more than this chart indicates because we don't have to have any losses on the underlying asset. We can end up just long our put. But yeah, if you do look at this graph, you can see if we trade below 135, we get below the call option we've sold for a large credit, and we're going to hit our maximum gain. In this case, $1.83 a share, or just over about 1.2% total return on 40% of our portfolio week over week. And so just to look at the math, we've sold a very juicy call option for $2.45. Now that in and itself won't necessarily create a profit. But once we add in the money put option for $1.54 debit, it makes our risk graph generate a profit if the TLT travels lower, and we generate a loss if the TLT travels higher. So we're going to earn money on the call option that we've sold as the TLT goes lower. And we're also going to earn a profit on the put option as it travels lower. And that profit will be greater than the loss that you're realizing on the TLT. Now, what has happened in the current trade setup, if you're assigned, you're pulling a profit on the TLT from the 247 collected, selling that call. And now we're just long the put. So our hope now is between today and Thursday that put does appreciate in value. But yeah, if we wanted to trade it differently, we could buy the TBT, which is the inverse of the TLT. We could just simply buy put options on the TLT. But that is a strategy that can have a lot more volatility and a lot more risk. So this is really our safe way to bet down on the TLT with the inverted option collar. And we've had some really nice gains on this in the past, doing exactly this trade setup. Now, one thing I do want to note is that, again, the chart doesn't have the ability to predict the volatility in the future. Let's see, I got a little bit of background noise. Let me just unmute Ron. Oh, let's see, where did Ron go? Oh, there he is. Okay. So yeah, does that make sense?
Yeah, the only thing is I track each one accumulative, and TLT is the only one I'm down in my portfolio.
Yeah, sure. So we've had we did spend a lot of time talking about this in the Q&A, but let me pull that up. So a lot of people will look at each part of the portfolio individually and not quite understand how they play together. So over the last 3 months, my primary concern has been that the Chinese would not sign a trade deal and put pressure on Trump. And that Trump, if he was going to deliver his promises on tough trade with China, would be forced to escalate, and that he would need to take action soon so that he could reverse this before the election. And so I've been actually thinking this since July. And so come October, we got the phase one trade deal when it was first announced. Now, China went back home and sat there saying that, yeah, we're not going to, we didn't say we'd do any of that. But from my perspective, the TLT was our cheap insurance or safe insurance to be able to bet up on equities and assume that this was the case. So if we do look at our SPY returns from October, let me zoom in a little bit. You can see we picked up some very healthy gains in the SPY over the last 4 months. And this was assuming that the trade deal would in fact be signed and that this was not yet another head fake in terms of the trade talks. Because for the past 2 years, China continued to say they would do one thing and their actions showed a completely different intent. Now, so far, that looks like they will sign the trade deal. And once we did have some confirmation from that in December, we officially switched our prediction on bonds from up to down. However, if they had not signed that trade deal and not lived up to their promises, the TLT had the potential to shoot up at least 10%. So from a risk to reward ratio, we lost approximately 3%. Now, I did add in our dividends in December, so we probably lost a little bit more in December, but made more January through November because there's a monthly.
That does it because I didn't come in until about October.
So the TLT was your insurance in case the China trade deal broke down from October through December. So I was willing to slow bleed on the TLT until we had confirmation one way or another.
Yeah.
Okay, so if we're up in the air with the trade war, our stance is to be long stocks and bonds. At this point, we don't feel like we're up in the air with the trade war. We feel like we're in a truce. So in that case, the bond market has gotten way ahead of itself. And that's why I believe yields will rise and the TLT will fall. And so if you can predict that move, there's a lot of money to be made. So sure, you're not happy that you've lost money for 3 months on the TLT. I don't blame you. But if you understand the very important role it played to protect your portfolio and the potential gain you could have had if the trade deal did not get signed, I think you can understand why we were long the TLT over the last 3 months. And don't forget, just in July, they told us the exact same thing. They said we have an agricultural purchase deal right out of Osaka. They came out and told us that. And then in August, Trump said, you know what? They're not living up to their promises. We're going to do tariffs in October and some incredibly huge tariffs in December. So we played it safe. We remained long the bonds until we had clarification. And I don't think anybody knew that we were going to really have a trade deal until the split last second. In fact, the way it rolled out, it looks like Trump just sort of said we had a deal, threw it out to China, and hoped they would agree to it. And I can remember the whole world waiting that morning to see what on earth China's response would be. And sure enough, they came out and said, you know what? Hopefully we've all learned a lot from this trade war, and let's try to have a better 2020. So if the trade deal is at a truce, which is what I would really call what we have, less of a trade deal, more of a trade truce, we know that the bond market has yields that are far too low and was really pricing a escalation in the trade war. So without an escalation in the trade war, bond yields should rise into 2020 as equities rally. And beyond that relief in the bond market from being stressed out that China's going to crash, their GDP is going to go below 6, their trading partners are going to be feeling the pain, and tariffs are going up. Well, now we have the exact opposite. We have rates staying steady. We have the Fed doing QE. So we have just some monstrous signs that yields should rise, and which is negative for the TLT, and that stocks will rally. So yeah, you could certainly wait for the bond market to sell off and then get back in. But there's some tremendous gains to be made to the downside. So it's totally up to you if you don't want to trade the TLT, because we slow bled waiting to see what would happen for 3 months. And so I wouldn't change the way we traded that.
Okay. Well, no, I trust you. Just that.
No, it's a good question. It's a great question. And so that's why we were long bonds in case the trade deal broke down, and we were long stocks during the same period. And so if we do remember, I haven't been pulling up our 3 trading plans, but if the trade war is up in the air, we're long stocks and bonds. If the trade war is in a period of de-escalation, we want to be short bonds and long stocks. And that's where I would argue we are currently at. And if the trade war is escalating, we know what to do. We want to be short stocks and long bonds.
Okay, I appreciate it.
Yeah, no, great question. And it's a common pain that our members have all had. They've seen their SPY profits getting washed away over the last quarter as we played it safe to close out the year.
Yeah.
And I still think we were a hair away from escalating and having tariffs in December. So looking back at it, I really would, if anything, I think we could have taken a little extra risk on the SPY and paid a little extra protection for puts on the TLT. And maybe we could have had a little bit higher return in those key months. But in terms of delivering a low volatility strategy for retirement, you have to be absolutely crazy to have just bet that there would be a trade deal, that the last 2 years of trade conflict was going to completely go away, and to have no downside protection. So when you look at it from that point of view, not being long bonds in the final stretch of 2019, when we had a deadline of tariffs on December 15th, and we'd had really no signs that Trump was going to back down, you have to be crazy not to have had that insurance in your portfolio. So this time, if you're just a buy and hold equity bag holder, you got lucky, and you probably have a few more months of being lucky ahead. But that strategy is the one that results in big losses when things aren't so rosy and don't go in a positive outlook for equities. But yeah, you can make a lot of the change of price is really how profits are created. And if we do look at the TLT in the big picture, you can see it has these vicious, absolutely vicious, horrendous sell-offs. And that's exactly what I'm expecting on the TLT. So there's about an $18 move at least before we should seriously consider flipping our prediction. So
we'll stay long the TLT, and then we'll just protect it with the options.
So yeah, think of the TLT as your vehicle for creating income from selling the in-the-money call, and then turning around and taking that capital to finance your downside bet. So because we have the capital to buy the lots of 100 shares of the TLT, we then have the right to sell the call option. And our bet is that the call option buyer is going to lose big time. And because he's losing, we're gaining, and we're taking that gain and putting it into a put.
Sounds good. I appreciate it, Jason.
Now there is an interesting setup where if we're assigned, we can get what I call a double payday. And that's what I was describing. Now, were you assigned on your TLT position?
No, it's gone. And that
Okay, good.
release was gone, but
That's great. So this is actually the best outcome. If we get lucky, this is what can happen when we're betting down on the TLT with what I call an inverted option collar. So just to reiterate what happened, we entered this position at 137.13. The TLT shot up literally a day after we put on the position from the attack in Iran. Now, what happened was we were assigned. So we sold the 135 call and we collected $2.50. So if you add that up, that's 137.50 per share when the TLT was trading at 137.13. Now I'm not counting the value of our put option at this point. So just on the short call and being exercised and assigned, we have a profit of 37 cents a share comparing the price we entered the trade on last Thursday and current. And what has this left us open for? Well, it's essentially financed 37 cents of our real bet, which is that we believe TLT is going to head lower. So now we're still long our 138 put. So if the TLT starts selling off into the rest of the week, we can actually get, again, the double payday. Now we do need that put to rise significantly to get a profit on the second half of the trade, that long put. The put option costs $1.54 and is currently worth 64 cents. So our loss is at 53 cents in total on this portion of the portfolio. Now, one thing to note again is that put options go up in value at a faster pace the faster it's going down, or the quicker the acceleration. So let me pull up this TLT trade. So this is the profit chart you could actually generate at the expiration, but we're closing this out with a day of time premium left. So we can actually make more than this chart would indicate because of the implied volatility, making that put option worth a little more than it normally would be.
Yeah, it's kind of like you were saying, you know, I was just feeling the pain from the loss in October, November, because my cost basis was actually higher than, but their point's well taken, that it's a balanced portfolio. And so
yeah, so it was a balanced portfolio during that time period because the trade war was up in the air. We really didn't know which way it was going to go. So we were long stocks and bonds.
right.
Going into 2020, we feel it's a de-escalating trade war and that the bond market was preparing for a real slowdown in China and for escalation in the trade war. So that's off the table now. So TLT needs to reset its price tag on yields, which are going to most likely be significantly higher. And that's when I suspect it can cause some trouble for stocks. So right now, we could actually outperform the S&P 500 with much less volatility, even though we have a stock bond portfolio. And that's because we're shorting the bonds. Now, the bond market could actually fall at a much faster pace than equities may melt up. That means the bond portfolio could realize profits faster than the SPY can until it does reset. So the ride to 120 should be fun and a nice profit in the TLT position after using it as our insurance against a trade war escalation over the last few months. So it's completely normal to have those feelings you are, and I hope that makes sense why we were long bonds when we had a really big headline risk of tariffs going up December 15th.
Great. Thanks, Jason.
Yeah, no, thank you for the question. It was a very good one. Karen still has her TLT, so that's fine. So we'll just close out the position as normal, Karen, and roll it into the next trade. Mark says, how are we prepared if this is just really another head fake? Yeah, so we have very little means of creating a profit in our portfolio if this is a head fake. Let's look at which parts of our portfolio could generate a profit if Trump was absolutely batshit crazy and wanted to not win the election and started escalating war with Iran and or China. So we're long gold right now. That's the only position that could benefit from chaos in the world because we're short TLT, but only on a weekly time frame. So if I really thought, and you guys know me quite well, I am Paranoid Pete, Negative Nancy, whatever nickname you want to come up with. I love to try to predict turmoil before it happens and position our product, our advisory, to really be the champion hero that delivers profits in downturns. And if you think about it, that really makes us stand out for investors who are going into retirement, who want to protect their portfolio and generate safe returns. So certainly I will be very happy to bet up on bonds if I really see a risk that I believe supersedes the macro picture that we're facing. Right now, I just don't see that. So if we do see something that does create enough risk that I believe we should be long bonds, well, we're only on a weekly time frame. We can flip that trade very quickly to point up. All we have to do is remove the option caller. Now, as far as protecting ourselves from a head fake, from chaos, well, we're not going to get destroyed. Most investors are just simply long their basket of stocks. And most likely they're going to see anywhere from a 5 to 10% volatility quake at any point. I would expect to see some 5 to 10% drawdowns on our path to 360 SPY, just from simple profit taking. We're protected against that. We're protected against an atomic bomb. We're really protected against anything because we have put options underneath all of our assets. So at this point in time, if the market were to sell off, we would get a small scratch on our chin and everyone else might get a broken bone. Okay. And that's because we have puts. Now we're not positioned to generate outlandish profits if there's chaos at this point. Now, back in the last quarter of 2019, had the trade war escalated, we would have outperformed and actually generated very, very attractive returns with the way we were positioned, because I was tighter on the downside protection on the SPY and I was looser on the TLT. Because if you remember, my prediction was the number one most likely outcome was that the trade war would escalate, and that the second most likely outcome is that they would at least have a truce and that we wouldn't really get a considerably measurable trade deal. And so far, nobody's seen the text. Nothing's been signed. All we really have are some soybean purchases and some rollbacks in tariffs. So I think Trump, even if they don't do what they promise, is going to be shy to escalate leading into the election. But happy to change that mindset the second we have enough evidence to really say that, hey, we need to be long bonds despite the risk of them selling off a good 15% from here. So that's the risk right now, is TLT could sell off 15%. So if we want to be long the TLT, we better have a darn good reason. Otherwise, that can continue to cause some pain in our portfolio. Now, if I saw Iranians retaliate, sure, we'll switch that position. If we see Chinese not purchasing agricultural purchases and not signing the trade deal, we could consider changing that position. Outside of that, I really don't see the risk in the market with interest rates this low, inflation low. The Fed's now talking about keeping this level of interest rates for 5+ years. So if that's the case, there's just free money everywhere. And so it's going to be very hard for equities to have a long-term sell-off, especially with corporate credit being so low, allowing Apple and Microsoft, which was 20% of the S&P 500's gain last year. Absolutely insane. Well, they can buy their own stock back nearly for free by issuing debt currently. The other thing to consider is the amount of debt being issued by the US government is monstrous. And so supply demand indicates that yields should rise until the Fed starts artificially lowering those rates by purchasing the notes and bonds. Right now, they're just buying very short-term debt, which is only artificially keeping your 1 month, 3 month, and 1 year treasuries yields low, while the rest of the curve is being allowed to float. So again, my expectation is these yields will rise to around 3%, and that will cause a stock sell-off and give the Fed ammunition to go into the next round of rate cuts. Banks know the plan. They buy these bonds at the high yield, expecting the Fed will cut rates as stocks pull back. And this allows the Fed to then rotate into quantitative easing. And this is, again, a sweetheart deal for banks. They buy the bonds during a crisis with high yields. The Fed lowers rates, which pushes yields lower and gives them a huge open profit on their bond position. And then rather than selling this into the open market, the Fed comes in with quantitative easing like clockwork, and the banks unload those bonds into the balance sheet, which they'll live there for until their duration. And this allows no risk for the banks to sell these bonds for a huge profit and turn around and buy stocks. So they do this time and time again. Yeah, paranoid Pete over here for you. So, there's been a few times, the July meeting, I was very nervous that the trade deal would falter. The October meeting, I was very concerned, and the December deadline. And all three of these outcomes turned out to be head fakes. But one day it won't be. And that's how we use the TLT to have a relatively inexpensive way to protect our equity position. So just a quick recap of what to expect the rest of the week. Tomorrow is Wednesday, so we're trading the SPY. We're going to be looking at different balance sheets than we did on Monday. So Monday, we looked at our core trading partners, Canada and Mexico, which are doing well, although they're not expanding their balance sheet as quickly as the US is, not quite as important. Brazil, we also looked at on Monday as a good leading indicator for health of stock market. It's tending to outperform the US in good periods and severely underperforming during periods of slowdown, and has acted as a leading indicator for stocks. So that was our Monday review. Today was emerging markets, so we focused on China, Germany, and South Korea. We're seeing that China is growing its money supply, but that Germany and South Korea has been slow to increase its balance sheets. And we do note that the central banks are pretty good at taking turns to make sure there's a constant supply of liquidity, keeping the world economy rolling. Tomorrow we'll be looking primarily at Japan and a few other of its key trading partners, looking at the growth of its balance sheets. Thursday will be all about inflation and rates. So we'll be looking at the 20-year and 30-year rates of all the major countries, as well as the gold-copper ratio, which can be very useful for predicting yields and inflation. And then Friday, we'll be focusing on Europe in relation to the expansion of their balance sheet and interest rate policy. And so through the course of a week, we really cover all of the biggest economies, keeping track of the central bank balance sheets, and to make sure that we have the right picture for 2020. Which can look simple, just up on stocks, down on bonds till yields get too attractive. And in the meanwhile, we're looking out for earthquakes and potential potholes in the road so we can protect our assets and know when to apply the right options on the right assets to deliver safe profits. All right. Did you want to do the closing piece now, Dean? Oh, it looks like Dean did. I think he got some calls, so he may have taken off already. Any last questions before I let you guys go for the day? All right. Well, I really appreciate everyone's time today. Again, we will have a new presentation tomorrow. Let's just see if I got a chat box that popped up. Nope. Okay, great. Well, tomorrow we'll close out our SPY position and get ready to follow up with the TLT GDX position Thursday and back to the SPY on Friday. So thank you all so much for your time and looking forward to tomorrow's presentation.